Well, with 1 hour left to go in the trading day, let's take a look at where North American markets are trading. And you can see the S&P 500 is holding on to that very small gain at this moment. We'll see how the afternoon unfolds. It had dropped into negative territory a little bit earlier, and the NASDAQ is also negative at this moment, down about 0.25%. The TSX, though, holding on to a small gain as well, up a little more than, or almost a 0.5% there to end this trading week. If you look at those three across the board on a weekly basis, they are all higher across that board. For more, let's bring in Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners with Raymond James. Brianne, what a treat to get to chat on a Friday afternoon. Thanks so much for making time.
Yeah, thanks for having me, Jacqueline.
So it's been an interesting week because we've got lots of earnings that have come out, but we have a lot to look forward to next week as well, and more Canadian companies that are going to be reporting, particularly a couple in the tech sector with Celestica kicking things off on Monday. But I wonder what you're thinking about just, tech in general, because it has been such a focus. But in Canada as well, and maybe just because there's a handful of companies that are tech companies on the TSX that it doesn't get as much attention, but it has been outperforming again.
Yeah, I think, tech in Canada, as you said, we are seeing some other notable like Constellation, OpenText, and, even Shopify, again, leading the way, kind of up 12%. From a Canadian perspective, right, we're seeing, a rally in technology. It is a little bit more narrow than the U.S., or say the Magnificent Seven that carried us last year in the U.S. Also, communications in Canada is doing well, and consumer staples are really leading the charge year to date. So I think from a broad-based perspective, Canada did lag the U.S. last year. I think from a GDP and economy perspective, we do expect Canada to be weaker than the U.S., and all the data is really pointing to that. So from an investment standpoint, I think we pivoted a little bit more defensively in Canada and are underweight. And more overweight the U.S. from an asset allocation and geographic allocation, but not to say that, as soon as we see things start to get fully priced into the Canadian stock market, that we won't pivot and take advantage of some of these sectors as we see a potential run up in Canada as well. So there's a lot of data coming out. Still the TSX is, up around 1% around there year to date. We're seeing the U.S. still outperform. I think right now rate cuts is going to still be front and center, and what that looks like, right? We saw Bank of Canada for January hold that. We see the U.S. on the 31st, and I think really the data we've been getting out of the U.S., there was a 50% or a 90% chance that we would see a cut in March from the U.S., and now it's about a 50% chance. So our expectations are that Canada is going to lead the cuts as well over the U.S.
And we're going to get Canadian GDP data next week. It's not quarterly data, but we did get the quarterly data out of the U.S. this week. And I just wonder what you made of it, because, the strength, the resilience that is persisting in the U.S. continues to surprise.
Yeah, I think in Canada, GDP data has been softer already, with Q3 economic growth falling into kind of negative territory. While inflation in Canada has been stickier, with CPI kind of inflation of 3.4 year over year for December, we like to remind investors, it is a year over year number. So, that is normal to think about where things were a little bit more elevated a year ago, last December. And we believe that if, economic growth does soften, the Bank of Canada does remain poised to execute its rate cut. So our expectations right now is that we do see the GDP report for Q4 that will be released next Wednesday as well. But we are expecting Canada to potentially be in a recession, if, close to, and would continue that slowing path. We think Canadians are a little bit more handcuffed than Americans with the amount of debt to income and debt to GDP levels that we do have. And that is something that we are monitoring closely and watching for our investors.
So if you're expecting, it sounds like the Canadian economy to be lagging that of the U.S., what would you be thinking about just sort of broadly when it comes to Canadian equities versus U.S. equities? Do you think that, we'll lag again this year for 2024?
Yeah, I think our expectations are right now, we see it as we want to be shifted overweight into the U.S. versus Canada. We could see, mining commodities could help bring up Canada a little bit. I think energy moderately positive. Still see outperformance in the U.S. is our expectations from an economic standpoint. So if we're in this soft landing in America and potentially in a recession in Canada, our expectations are to continue to see the U.S. and the U.S. stock market perform well. I think it is a little too early right now to be able to make that call to tactically shift overweight to Canada. But we still own some reputable Canadian companies. And we will buy into weakness in Canada once we've seen that fully reported in the Canadian stock market.
Dollarama is one that you like right now, Brianne?
Yeah, Dollarama, great consumer staple, is one of Canadians' biggest retailers. $5 or less, I like to say. They have over 1,500 stores now. And in the last 10 years, really the company has been growing its stable, 10%, while their net income has been growing 13.8% annually. So last earnings results, they missed earnings, but barely. But they also obtained greater earnings per share by 7% more than expected. So the company's financials are very solid. It's ranking fundamentally a 10 out of 10 for us. And the stock year to date is still up almost 5%.
I wanted to just quickly get your thoughts too, Brianne, on a big mover today, and that's Intel. I wonder what you make of the reaction that we've been seeing in the markets today.
Yeah, Intel is not a stock that we own. We saw obviously yesterday it was down big on weaker than expected Q1 guidance. And that really, I think, with its focus on that continued share loss in their data center compute. So for us, it's a stock we don't own, and we don't really want to continue to own at this time. Mm-hmm. So not really in our wheelhouse right now. But again, yeah, we did see a big sell-off in their post earnings from yesterday.
Yeah.